Well, let's turn now to the Fed. Chicago Fed President Charlie Evans making new comments on the economy to CNBC's Steve Liesman. Steve has those headlines, and he joins us now with more. Steve.
Morgan, thanks very much. Chicago Fed President Charlie Evans saying he sees a need to cut rates by up to 50 basis points in the coming year to lift inflation back to, and then he wants it to run above the Fed's 2% target to show that the Fed is symmetrical. Speaking at the CNBC At Work event in Chicago, Evans said for the first time the economy may even need more than 50 basis points of easing. He said he's also concerned about weaker global growth and potential negative impacts from trade tensions. On the issue of the president's Fed criticism, Evans said it goes with the territory if you're a central banker, but the central bank should not be in the business of providing excess stimulus to improve growth. All that said, after Powell, the chairman, talked today, and Evans, here's where the Fed probabilities stand. 100% chance of rate cut in July, 76% chance of another rate cut come September, and 56% in December. So 3 rate cuts, Morgan, pretty much built in to the Fed funds futures market at this point.
Steve, thanks. Stay right there. We're going to bring in Art Laffer from Laffer Associates. Art, thanks for joining us today. Want to get your reaction.
My pleasure,
Want to get your thoughts on these comments from Evans, and also how likely it is that we do see as many as 3 cuts this year.
Well, I think Steve's right when Charles Evans said we could have a cut 50 basis points in the Fed rate, maybe even more. You know, you see a lot of softness in the rest of the world except for the U.S., and the U.S. could well afford to have lower rates. I think it's time now for it. The long bond has dropped a lot in yield, and, you know, it's just natural that the Fed would follow the market, and 50 basis points seems like about right to me.
When you see stronger retail sales data, for example, that we got this morning, does that worry you that we might not see that rate cut, despite where the Fed funds futures expectations are?
Well, here I'm trying to mind read what the Fed has in mind. Stronger retail sales does not mean there's more inflation expectations or anything like that. Stronger retail sales is just stronger retail sales. I think the issue of inflation is really behind us. We don't have an inflation problem, and we have an interest rate problem vis-a-vis the rest of the world. And I think that's where we lower those rates. And I don't know how the Fed thinks on these issues, but I'd be very surprised if they don't lower rates by 50 basis points or maybe even a little more.
The dollar's a lot stronger today, in particular, in fact, the euro, the pound as well, but the euro significant mover to the downside. Do you agree with the president that you think the European Central Bank purposefully weakens its currency? And overall, would you want the situation that the ECB faces versus what the Fed faces at the moment?
You know, it's highly likely that they did purposefully lower the exchange rate to encourage exports and reduce imports. I don't know what their logic is again there, but the dollar strength is not a problem from my standpoint. I've never seen a strong economy that doesn't have a strong currency as well. And the U.S. dollar being a little stronger just gives only more credence to the argument for lowering interest rates here in the U.S. Strong currencies have much lower interest rates than do weak currencies. And we're a strong currency, we're a strong economy, and we really need to keep that prosperity going.
Steve, I want to get your thoughts on this op-ed by... Oh, go ahead. It sounds like you have a reaction to... Go ahead,
Steve. Well, it's funny. We just talked to Charlie Evans about that, and he just basically pointed out that the research shows that you can't do much that will cause a currency to move in a predictable way because it depends on what the other side is doing. I remember Alan Greenspan, Arthur, used to say that there's no factor that can tell you the direction of a currency that does a better job than the flip of a coin. And he said maybe the research shows 4 years out, you know, the Fed could cut rates and then who knows what the ECB does or the emerging markets do or China does. And I think I want to commend you for saying that, you know, the dollar should not be the focus of Fed policy here. And I'll just say one of the reasons, Arthur, is because the U.S. economy is so dynamic. You have dollar strength winners and you have dollar strength losers. And you can do the same thing for dollar weakness. And it's just unclear what is the best outcome for the U.S. economy.